This is the financial crux of the moment, and what a week we are witnessing in the markets. Gold has officially reclaimed the $5,000 per ounce level. Silver is back at $80. But behind this explosive price action, something far more important is happening at the Federal Reserve, and most investors are completely missing it. Today I'm going to break down exactly what's going on, why it matters, and what this shift could mean for silver prices in the months ahead. Before we dive into the data, let me ask you something. Drop a comment right now and tell me where you're watching from. Are you tuning in from the United States, Canada, the UK, Australia, India? I want to see where this community is spread across the globe. It helps me understand who I'm speaking to and when these uploads reach you best. So drop your location below and let's get into it, because there is a lot to cover. The Federal Reserve's balance sheet is making a dramatic U-turn. After years of shrinking its holdings, we are now seeing early signs of stabilization and even expansion. This isn't speculation. This is visible right now in the data. And if you understand what this shift has meant historically, you'll understand why silver may be on the verge of a major move higher. Let's talk numbers. At its peak in 2022, the Fed's balance sheet reached roughly $8.8 to $9 trillion, driven by unprecedented money creation during the pandemic years. Since then, the Fed has been running quantitative tightening, allowing bonds to mature without reinvesting the proceeds. That process brought total assets down to around $6.6 trillion. But here's where it gets interesting. That decline has stopped. Total assets are stabilizing, and in recent weeks, we've started to see them tick higher again. This reversal, from contraction to expansion, looks eerily similar to previous liquidity cycles that kicked off major market rallies. Let that sink in. In my previous videos, I've been tracking global liquidity cycles and explaining how they drive asset prices. And if you've been following along, you already know this. When central banks shift from tightening to easing, when balance sheets stop shrinking and start expanding, it often marks the beginning of an entirely new market phase, and the leaders in those phases tend to change. Right now, the data suggests precious metals, especially silver, are positioning to lead the next wave. Think back to 2020 and 2021. The Fed expanded its balance sheet by trillions of dollars. Silver exploded from around $12 per ounce in March 2020 to nearly $30 by August, more than a double in less than 6 months. Gold surged from roughly $1,500 to over $2,000. Those moves weren't random. They were directly tied to the liquidity flood created by central bank balance sheet expansion. Now, I'm not saying we'll see an exact repeat. Markets never move the same way twice. But I am saying the setup is rhyming. The Fed's balance sheet contraction is ending. Early expansion signals are appearing. And if stress fractures begin to show in the financial system, which I'll get to shortly, the central bank will likely open the floodgates again over the next year. Quick pause. Roughly 70% of you watching right now aren't subscribed. If this analysis helps you see the markets more clearly, hit the subscribe button. It costs nothing, but it allows this channel to keep delivering deep, data-driven insights. You can also join our WhatsApp community, link is in the description, and follow us on X, Financial Crux, where I post real-time updates throughout the trading day. Now back to the markets. Gold at $5,000, silver at $80. These are not small moves. What's even more striking is how fast sentiment has flipped. Just weeks ago, we saw heavy selling pressure, forced liquidations, margin calls, and aggressive paper selling pushing prices lower. I documented all of this in earlier videos, but the physical market told a very different story. We saw queues forming in Singapore and Australia for physical metal. Dealers across Europe pulled their offers entirely. In China, premiums on platforms like JD.com surged 90 to 100% above Western spot prices. That divergence between paper and physical was sending a clear message. The paper price was not reflecting reality. And now, we're watching the paper market finally catch up to what physical demand has been signaling all along. As I'm recording this, spot gold is trading near $5,000 per ounce, and spot silver is hovering around $80 per ounce. And this move, if the liquidity trend continues, may only be getting started. The Shanghai Premium, which I track closely as a real-time indicator of physical market tightness, remains elevated. That alone tells us something important. Physical demand in Asia continues to outpace what Western paper markets are pricing in. At the same time, silver remains in backwardation. For anyone unfamiliar with that term, backwardation means the spot price is higher than the futures price. In a normal, well-supplied market, futures trade above spot to account for carrying costs like storage, insurance, and financing. When that relationship flips, when spot trades above futures, it signals urgent demand for immediate physical delivery. In other words, it signals tightness, it signals stress. and it signals that the paper price is not accurately reflecting real supply and demand conditions in the physical market. Now let me ask you something. How many of you have been stacking physical silver? Drop a comment below if you've been accumulating. And if you haven't started yet, what's holding you back? Is it price uncertainty? Is it not knowing where to buy? Let me know, because I want to create content that directly addresses your questions and concerns. Here's what most people are missing about this shift in the Fed's balance sheet. This is not just a U.S. story. Central banks operate in a loosely coordinated system. When the Federal Reserve shifts policy, other major central banks often follow. And we're already seeing this play out. The European Central Bank, the Bank of England, and the Bank of Japan are all navigating their own versions of this same liquidity dynamic. When you look at global liquidity across all major central banks, the data shows clear signs of bottoming and potentially turning higher. And here's what makes this even more significant. There is a documented rotation underway from crypto into precious metals. Over the past year, Bitcoin and other cryptocurrencies have experienced extreme volatility. Many investors who initially allocated to crypto as a hedge against monetary debasement are now rotating a portion of that capital into gold and silver. The reasoning is simple. Precious metals have 5,000 years of history as money. They carry no counterparty risk. They cannot be hacked, frozen, or shut down. And when the physical market is showing clear signs of tightness, while paper prices remain artificially suppressed, the value proposition becomes very difficult to ignore. I want to be very clear about something. I'm not here to tell you what to do with your money. That's not my role. My job is to present the data, share my analysis, and help you think through the implications. You need to do your own due diligence. You need to understand your own risk tolerance, and you need to make your own decisions. Anyone promising a guaranteed path to riches is either lying or selling something. I'm doing neither. So let me walk you through what I'm watching right now and what could unfold in the weeks ahead. I see two primary scenarios. Let's start with the bearish case, because risks always need to be addressed first. If the Federal Reserve fails to follow through on balance sheet expansion, if they continue tightening or hold steady while economic conditions deteriorate, we could see renewed selling pressure across risk assets. In a true liquidity crisis, investors don't sell what they want to sell. They sell what they can sell. Gold and silver, being highly liquid markets, often get hit during the initial phase of deleveraging as investors raise cash to meet margin calls or cover losses elsewhere. We saw this in March 2020, and we've seen versions of it more recently. The metals sold off sharply at first, only to reverse course once the Fed stepped in. So the risk here is clear. If something breaks in the financial system, a regional bank, a hedge fund, or a stressed corner of the credit markets, we could see another wave of forced liquidation that temporarily pushes prices lower. There are other headwinds to consider as well. A stronger US dollar would pressure precious metals, since they're priced in dollars. And if equity markets stabilize and risk appetite returns, some capital could rotate out of safe haven assets and back into stocks. The S&P 500, despite recent volatility, still commands massive institutional allocation. Any sustained rally there could pull attention away from metals. That's the bearish case. Now let's talk about the bullish case, because this is where the data becomes far more compelling. A reversal in the Fed's balance sheet has historically marked the beginning of liquidity expansion. Every major precious metals rally over the past 2 decades has been tied to some form of quantitative easing or central bank balance sheet growth. If the Fed continues down this path, and especially if they accelerate in response to financial stress, the upside potential for gold and silver from here is significant, and the physical fundamentals remain overwhelmingly bullish. We're seeing documented shortages across multiple regions. Dealers are struggling to source supply. Premiums remain elevated, and those signals are not weakening, they're strengthening. Retail demand remains strong. Central bank buying continues at record levels. None of this has changed, despite the extreme volatility we've seen in paper prices. The gold to silver ratio is currently sitting around 60-1. Historically, over long periods, that ratio has averaged much closer to 15-1. When you look at mining ratios, above-ground supply, and vault inventories, they all point to the same conclusion. Silver is deeply undervalued relative to gold. If silver were to revert even halfway back toward historical norms, we're not talking about modest gains. We're talking about prices multiples higher than where we are today. At the same time, the debt situation continues to deteriorate. The United States has nearly $10 trillion in marketable government debt maturing over the next 12 months, the largest amount in history. Most of that debt will have to be refinanced at higher interest rates than when it was originally issued. As a result, interest expense on the national debt now exceeds defense spending. That is not sustainable. And when it becomes clear that there is no political or fiscal path out of this, the reality sets in. The only viable solution is inflation. The The only way to reduce the real value of this debt is to debase the currency. And in that environment, precious metals benefit enormously. Geopolitical tensions also remain elevated. Without getting into political commentary, the global order is shifting. Traditional alliances are being questioned. Trade relationships are being restructured. And central banks, particularly in Asia and the Middle East, are actively diversifying away from dollar-denominated assets and into physical gold. This is not speculation. This is visible in the data. Central bank gold purchases have been at record levels for 2 consecutive years. Now, some of you may be asking a very reasonable question. If the fundamentals are this bullish, why all the volatility? Why did we just witness that massive sell-off? Here's the answer, and it's critical to understand. What broke was not the physical market. What broke was the paper market. The selling was concentrated in futures, leveraged ETFs, and derivative products. It was driven by margin calls, forced liquidations, and algorithmic trading that triggered cascading stop losses. Meanwhile, the physical market told a completely different story. As paper prices collapsed, people were lining up to buy physical metal. Dealers were selling out. Premiums exploded higher. That divergence between paper and physical cannot persist indefinitely. Eventually, one of these markets has to give. And history shows that when paper and physical diverge, paper breaks, physical doesn't. Paper contracts are promises. Physical metal is the asset. When enough participants demand delivery, when paper claims exceed available metal, the paper market is forced to reprice violently to reflect physical reality. We may be approaching that point. Both COMEX and the LBMA, the primary Western precious metals exchanges, have seen significant inventory drawdowns over the past year. Registered and eligible inventories are sitting near multi-year lows. At the same time, Eastern markets, especially Shanghai, are accumulating metal. Gold and silver are flowing from west to east. This geographic shift in physical metal is one of the most important and underreported developments in the precious metals market in decades. Let me pause here and ask you something. What was your reaction when gold hit $5,000 and silver hit $80? Were you excited? Nervous? Did you wish you'd bought more earlier, or did you see it as an opportunity to take some profits? Drop a comment. I'm genuinely interested in how this community is navigating the volatility. And for those of you who are new here, let me be absolutely clear about what Financial Crux stands for. We do not sell signals. We do not sell courses. We do not offer paid mentorship or subscriptions. If anyone contacts you claiming to represent Financial Crux and asks for money, they are a scammer. Block them immediately. Our only platforms are YouTube and X under the name Financial Crux. That's it. Protect yourself from impersonators. I will never ask you for money. What I do here is analyze publicly available data, share my interpretation, and try to cut through the noise and hype that dominates most financial commentary. My goal is to help you think more clearly, not to think for you. Independent thinking is everything in markets. The moment you outsource your thinking, you become vulnerable to manipulation, to marketing, and to agendas that may not align with your interests. Now here's what I'm watching closely in the days and weeks ahead. First, the Federal Reserve's balance sheet, released every Thursday. I'm watching to see whether the stabilization we've observed continues and whether it turns into meaningful expansion. Any sustained increase would be bullish for precious metals. Second, I'm watching the US dollar index. A weakening US dollar is generally supportive of gold and silver prices. A strengthening dollar, on the other hand, creates headwinds. Recently, the dollar has been relatively stable, but any decisive move in either direction will have a direct impact on precious metals. Third, I'm watching Bitcoin and the broader crypto markets. I've said this before. Bitcoin often acts as a leading indicator for risk sentiment. Crypto trades 24/7, so it frequently reacts to shifts in news and psychology before traditional markets even open. If Bitcoin stabilizes and begins trending higher, that suggests improving risk appetite. If it continues lower, it signals ongoing stress beneath the surface. Fourth, I'm closely tracking the Shanghai premium, the difference between silver prices on the Shanghai exchange and Western spot prices. When that premium remains elevated, it indicates strong physical demand in Asia and tightness in the global physical market. If the premium compresses sharply, it may signal weakening demand. If it expands further, it tells us the opposite. Fifth, I'm watching Treasury yields. Rising yields can compete with gold, since gold pays no interest. But context matters. If yields are rising because investors are demanding higher compensation for credit risk, because confidence in government debt is eroding, that can actually be bullish for precious metals as a safe haven alternative. Sixth, I'm watching for stress in the banking system. The regional banking situation in the United States remains fragile. Commercial real estate exposure is a ticking time bomb for many smaller banks. Any headline signaling renewed stress could quickly trigger a flight to safety, and gold and silver historically benefit in those moments. Now let me pull all of this together at the macro level. We are at an inflection point. The 40-year bull market in bonds is over. Interest rates are not going back to zero, at least not without serious financial system stress first. The debt dynamics of major Western governments are fundamentally unsustainable. Something has to give. The Federal Reserve is trapped. If it continues tightening to fight inflation, it risks breaking parts of the financial system. If it eases to prevent a crisis, it risks reigniting inflation. There is no good outcome, only less bad and more bad. And in that environment, precious metals play a critical role. Gold and silver are nobody's liability. They can't be printed. They can't be devalued by policy decisions. They've served as money for thousands of years across civilizations. When faith in paper currency, government promises, and central bank credibility begins to weaken, precious metals provide an anchor. I'm not saying this to create fear. I'm saying it because I believe this is the reality we're facing. You can ignore it. You can hope the debt situation resolves itself painlessly, or you can position yourself for the range of outcomes that history suggests are possible. For me personally, and I'm sharing this only as transparency, not advice, physical precious metals form a core part of my savings. I don't view them as a get-rich-quick trade. I view them as insurance against monetary disorder, a way to preserve purchasing power across whatever economic environment unfolds. Others will have different strategies and risk tolerances, and that's perfectly fine. What matters is that you have a strategy, that you've thought through the implications, and that you're acting on your own analysis rather than following the crowd. Speaking of community, I want to acknowledge everyone engaging thoughtfully in the comments lately. The quality of discussion has been excellent. Some of you are sharing real data from your local markets. Others are asking smart questions that help shape future content. That's what a real community looks like. Not blind followers, but independent thinkers, sharpening each other's perspectives. If you want to be part of that in real time, join our WhatsApp group. The link is in the description. That's where I share quick updates and where members report premiums, dealer availability, and on-the-ground conditions from around the world. And make sure you're following us on X @FinancialCrux. In volatile markets, things can change fast. Now let me address a question I know many of you are asking. What's my price target for silver? I don't give price targets, not because I don't have opinions, but because price targets create a false sense of precision in uncertain markets. Anyone telling you silver is definitely going to $150 or $200 is either guessing or chasing clicks. What I will say is this: if you believe, as I do, that the fundamental backdrop supports higher precious metals prices, then volatility is an opportunity, not a threat. Whether silver goes to 90, 100, or 150, I can't tell you. What I can tell you is that the conditions that historically drive major price appreciation are firmly in place: Fed balance sheet expansion, physical market tightness, unsustainable debt dynamics, geopolitical uncertainty, and record central bank accumulation. These aren't short-term catalysts. These are generational forces. The real risk is timing. Markets can stay irrational longer than you can stay solvent. Paper manipulation can persist. Volatility can shake out even investors with the correct long-term thesis. That's why position sizing matters. That's why leverage matters. Or rather, why avoiding excessive leverage matters. And that's why a long-term perspective is critical. For context, in 1980, silver peaked around $50 per ounce. Adjusted for official CPI, that's well over $150 today. Using broader inflation measures, the real high could be north of $300. At $80, even the most conservative adjustment suggests silver would need to roughly double just to match its prior real high. Let me close with a quick summary. The Fed's balance sheet is shifting from contraction to expansion. Historically, that marks the start of liquidity cycles that lift precious metals. Gold is back at $5,000. Silver is at $80. Physical markets remain tight, premiums are elevated, backwardation persists, and dealer shortages continue. Paper markets are volatile, but physical demand is strong. Capital appears to be rotating from crypto into metals. Government debt dynamics are unsustainable and ultimately resolve through default, austerity, or inflation, and precious metals benefit in all three scenarios. Central banks continue accumulating gold at record levels. Against this backdrop, the question isn't whether precious metals belong in a portfolio. The question is how much and in what form. Those are decisions only you can make. What I'll continue doing is tracking the data, sharing my analysis, and helping this community navigate what comes next. Make sure you're subscribed, join the WhatsApp group, follow us on X, do your own research, think for yourself. Don't follow anyone blindly, including me. This is real risk. This is real volatility. Invest with logic, not hype, and I'll leave you with this. Silver at $80. Are you buying, holding, selling, or waiting? Let me know in the comments. Financial Crux out.